Welcome to Candid Conversations for Financial Markets podcast series. I'm your host, Laura Paglia, President and CEO. Our podcasts are designed to provide insights, transparency, and provocative yet achievable proposals for matters that move financial markets in Canada. We are delighted to be joined today by John O'Connell, CEO of the Oasis Group, a firm specializing in helping wealth management and technology firms with technology selection, implementation, sales process, and strategy. John has over 30 years of leadership experience in emerging and established organizations, including Merrill Lynch, KPMG, Oracle's, FinTech, and globally traded public companies. He is also the author of The Rise of the Activist Investor and invented the Activist Investor arc to describe how retail investors progress through phases of activist investing. The Oasis Group has published several articles and insights about prediction markets, particularly in the context of wealth management, investor behavior, and regulatory developments. Welcome, John.
Thank you very much for having me, Laura.
So why don't we start with a description of what is a prediction market today?
Sure. Think of prediction markets like a financial exchange where people trade on outcomes rather than underlying assets. So each contract in a prediction market is binary. It either pays $1 if an event occurs, or it pays nothing if the event does not occur. So they're very binary. And what happens is the price at any given moment reflects what the investors, the crowd of investors, collectively believes the probability of that outcome is. So for example, let's say the investors have a contract on a federal rate cut, and that's trading at 70 cents. That means what the market is saying is that there is a 70% chance that a rate cut happens. So these are not polls, these are markets. And when you see someone that exits a poll, as an example, they may give an opinion, but they may be telling you the opinion they think you want to hear. When there's money at stake in these markets, that changes how people behave. So what happens is you find that these are pretty good predictors of market movements and of economic movements and of outcomes because there's money at stake. So people are, I would like to say they're honest in a poll, but when there's money involved, they're literally, trading on that outcome. So you get a pretty accurate result of what the market believes is going to happen.
What would you say is the biggest misconception or misunderstanding about these markets?
I think the biggest misconception or a common mistake is treating prediction markets like gambling. It's not gambling. They're very different. So, and that framing is kind of, it's a little incorrect, and it leads people and firms to really make a poor decision of how to respond to these markets, right? People feel like gambling is not, they've got an opinion on gambling, so they use that opinion behaviorally to respond to one of these markets. And that's actually an incorrect way to look at this. Kalshi operates under the same federal regulatory framework in the United States as the Chicago Mercantile Exchange, as the CME Group. What that basically means is contracts settle on verifiable data. It's not chance. Either this event occurs or it doesn't occur. So in February 2026, the Federal Reserve economists actually published a working paper that validated Kalshi's forecasts on statistically competitive information. And they basically said that Kalshi's forecasts are at the same level or better than professional surveys and even the Bloomberg consensus. When the Fed publishes research treating a platform as a macroeconomic benchmark, the gambling framework doesn't just hold anymore. It fails completely. This is an academic body looking at academic rigor around the prediction, around the statistical prediction of an outcome. And they're saying that Kalshi's statistical performance at forecasting events is at an academic level. Any wealth manager that that dismisses these markets and says that they're just gambling is really leaving this huge gap in their understanding of, number one, how these markets work, and more importantly, client behavior around these markets.
So, thank you for that context. How big is this market right now?
It's enormous, actually. The growth numbers are pretty extraordinary. I mean, when you think about it, the monthly trading volume across all of the major prediction markets went from under 100 million in 2024 to 13 billion in November of 2025. That's a 130-fold increase in just 2 years. Total trading volume for 2025 on Kalshi alone, well, total trading volume exceeded 44 billion. On Kalshi alone, they generated over 260 million in revenue last year. That's a 1,000% year-over-year revenue growth in these markets. Any asset manager or exchange-based market that had that kind of growth, it would be headlines around the world. And Kalshi has seen that kind of growth. So now looking forward, there are projections, for example, Ehlers and Krejcik, I think is the pronunciation of it, predicts a $1 trillion in annual trading volume by the end of the decade. So this is not a niche market. This is a asset class that's in formation right now, but it's moving so much faster than any other asset class that we've ever seen. This is moving significantly faster than the crypto asset class ever moved. So I think what we're seeing in the market today is there's demand for these markets that's driving unbelievable growth in these markets. And to ignore that asset class today is to really do a disservice, I think, to your investors.
Thank you, John. How is it growing from niche to big? Could you walk us through the mechanics of how you've seen that evolve?
Yeah, I think, if you take a look at some of that explosive growth, you've got to kind of look at who are some of the investors that are in the room, right? That's, I think, very important. So in April of 2024, Susquehanna International Group, which is one of the largest options makers on the planet, launched a dedicated trading desk exclusively for contracts on Kalshi. That's a first. To have one of the largest and most respected options market makers in the world create a trading desk around these types of contracts says something very significant. So CME Group, who's the world's largest future exchange, has now partnered with FanDuel to create and develop what we call these event contracts. So they're going to be developing retail event contracts. That means they're going to be developing contracts that are very similar to what Kalshi is providing in the marketplace today. So that's very significant. Intercontinental Exchange, who owns the New York Stock Exchange, made a $2 billion strategic investment in Polymarket, one of Kalshi's competitors. And then I mentioned a moment ago, the Federal Reserve publishing the working paper this past year, citing that Kalshi is a performance forecasting benchmark that is recognized by the Federal Reserve. When you've got financial institutions of that caliber that are committing capital, researching the platform, and then acknowledging that the platform is viable, that's literally the definition of mainstreaming. So the move from niche to mainstream has gone incredibly fast. But I think that some of the reasons you've seen that are the investors that are getting into it. The second point that I'll make is Robinhood now contributes more than half of Kalshi's trading volume. Robinhood is the largest retail brokerage in the United States, and it's now Kalshi's platform's single biggest contributor. So what does that tell you? Well, Robinhood targets primarily next generation investors. So that means this is not only an asset class being recognized by the Federal Reserve, by communities like the New York Stock Exchange, CME Group, Susquehanna, This is a legitimate asset class in the eyes of the next generation investor. Because of those trading volumes, this is not a fad. They're investing in this market significantly. And for a wealth management firm that may have clientele that are entering their distribution years or maybe are already in their distribution years, unfortunately, that wealth is going to transfer. And when that wealth transfers to the next generation investor, if you don't understand this market or you're turning a blind eye to it, you're turning a blind eye to these next generation investors. And I think that is perilous if you want to have an ongoing concern. If you're a firm that wants to live for a long period of time, that is ignoring that market is probably not the way you want to go.
How, in the United States, how is this market being regulated?
So in the US, all of the prediction markets, any prediction market contract falls under the Commodity Exchange Act, which is regulated by the CFTC. So any platform like Kalshi is registered as a designated contracts market. It's the exact same legal category as the Chicago Mercantile Exchange. So CFTC regulates the authority to prohibit certain types of contracts that it feels are contrary to the public interest. And it actually has a ruling on that, section 40.11.13. Kalshi challenged that authority in court in 2024 and won the case. And CFTC dropped their appeal in May of 2025, which shows you that the CFTC recognizes that this is an emerging asset class, and it's better to embrace the asset class and determine how to more effectively regulate it for the investor's best interest than to fight it. So the new CFTC chairman, Michael Selig, has publicly commented that they're going to support the lawful innovation of the events contracts market. So the regulatory posture has really shifted in the United States from an opposition posture to a facilitation of regulatory posture. And that pivot really matters enormously on how this market develops, right? There are certain event contracts that are on these markets that are questionable. The fact that CFTC is now going to step into a regulatory posture on this means that you're going to see more regulation come out that limits some contracts that are not appealing, right, or maybe questionable versus contracts that have a legitimacy in market content. And it also means that CFTC is going to take a much more direct approach in everything that you would expect from a contracts market: surveillance, KYC, AML reporting, all of the regulatory rigor that you would expect to see in any market, you will now see moving much more strongly in the predictions market.
Okay. Thank you, John. You mentioned the great wealth transfer. Um, are there more than one group of demographics that's really driving the adoption of prediction markets?
Absolutely. It's not limited to young investors, right? You're seeing this kind of across the board. So you're seeing this in people that are that have are political aficionados, right? And they're looking at prediction market contracts based on certain election outcomes. You see people in that are economists that are looking at their tea leaves, and they're taking contracts, entering contracts based on economic indicators like federal rate cuts, unemployment, the CPI. So these contracts are spanning kind of every demographic. I think one of the things you have to watch out for is a lot of people look at it and say, well, it's sports betting. That's not the case. It might have originated in that kind of a bend, but it's matured and really evolved so quickly and so significantly to encompass a whole host of these types of contracts that it's you're kind of putting a blinder on if you're thinking that this is a sports betting. It's not. These are defined outcomes. These are are regulated contracts, and they're under the same level of scrutiny that you'd see under any kind of commodities contract.
So with respect to the perception that these are sports betting, um, I'm going to give you a general statement for your thoughts on. The prediction markets now seem to span a wide spectrum. And on one hand, they have been criticized as encouraging potentially harmful behaviors. So, um, investing in whether a company's going to go bankrupt or whether someone's going to die or get shot, to what's been called speculative curiosity, like who's going to win an election, um, to also being described as bringing benefits to society, like being able to do better public forecasting, better crisis planning. What are your views on that kind of a summary?
I think that what you're seeing at this point is there, you know, this spectrum of is there good behavior and bad behavior is fairly accurate at this point, right? Contracts that are tied to um, outcomes that are questionable, like you mentioned, like a death or a disaster or a corporate crisis, they create a moral hazard, and I think people need to really take a look at what are some of these contracts look like and whether or not they want to be involved with them. Also, I feel like what you're finding at this point is that the regulatory environment is going to put more rigor around those types of contracts, right? So contracts that are tied to a death of someone or contracts that are tied to a disaster, you're going to see regulatory intervention on those types of contracts. And you can see that just in the posture change that you're seeing with CFTC. So, when you take a look at some of these, some people may also argue, for example, like political contracts. Should someone be engaging in the prediction markets in a contract way based on an outcome of an election? Hmm. The reality of it is these provide both good and bad. If you take a look at the prediction markets the prediction market contracts and their ability to, quite frankly, predict or forecast an outcome of an election, they're significantly more accurate than an exit poll. So there is a good aspect of this in that you can get better data. The economic data coming out of them was very good. In fact, when you took a look at the Fed 2026 research, it demonstrated that CPI, payroll, federal policy contracts produced generally viable forecasting signals if you looked at these markets. So the policy challenge that you see being drawn at this point is really principled lines between what is considered to be an inappropriate contract versus what is considered to be a good contract or a contract that fits the policies that we're going to be rolling out and you're going to see moving forward. That policy challenge is becoming really stark really quickly. In fact, CFTC, um, their public interest standard under that same regulation, 40.11, exists precisely for this purpose. And it's the right mechanism to be able to drive this distinction between what's an inappropriate contract and what's an appropriate contract. So it's not like we're going to need to create new policies to create enforcement. Those policies exist. We just need to move towards enforcement.
Okay. In the foreseeable future, over the next few years, what would you say are the practical steps that wealth management firms and advisors in the United States should take about these markets?
Well, one other thing that I want to cover really quickly on the last question you had was really just manipulation concern. I get asked that a lot. Is there market manipulation that it can occur in these prediction contracts?
Yes.
And the market manipulation concern is really most acute when you're looking at sports or you're looking at like a political market, right? Where you may have thin liquidity in that market, which makes the price movement much easier, right? Um, Even look at our existing commodities market today. As vibrant as it is, there are times where there are thin positions in the commodities market and market movements can be quite stark. They can be pretty volatile in some cases. When you're looking at economic markets, though, with these prediction contracts where they're trading hundreds of millions of dollars are moving around in some of these prediction markets around this consumer price index, Fed decisions. It's much more meaningful to restrain any manipulation when you've got the volume, right? Again, I want to point back to we have a regulatory framework already in place for thin markets and to avoid market manipulation. So it's really just coming back to that framework to kind of drive that. Now, your last question, which was how should the wealth management industry kind of pay attention to these, or what should wealth managers be thinking about it? I think advisors really need to pay attention for the same reason that they pay attention to anything that affects client behavior or financial outcomes or the behavioral finance side. Clients are already taking advantage of these markets. They're already trading in these markets through marketplaces like Robinhood, Kalshi, Polymarket. And because Robinhood's contributing so much of Kalshi's volume, more than half the volume, this is not a hypothetical future risk that's happening. This is risk mitigation that's happening right now. And the current reality is most firms have not built a response to any of these questions, right? Like a lot of firms are like, well, we're not trading in that. Well, think about some of the other implications, right? Your client may have filled out a risk tolerance questionnaire years ago, and you haven't had them fill it out again. Well, if you knew that they were in the prediction markets, could that affect their risk tolerance score? Absolutely. If you're trying to be a financial quarterback and truly be a fiduciary for your client, you should be looking at both the balance sheet and the liability side of their personal balance sheet. That asset side of their balance sheet includes their prediction market trading. So you should understand at this point what they're doing in this. The real-time Kalshi probability distributions that we're seeing around Fed decisions, CPI, GDP, those can also be used by an advisor to continuously engage in macroeconomic signals that other data sources may not be providing them, right? So unless they're subscribing to a really expensive pay for data service, they may not have access to many of the real-time or the near real-time predictions that are happening and the forecast that you see on some of these macroeconomic indicators. Looking at what's happening with the prediction markets gives them access to look at some of those macroeconomic indicators that are coming out. So firms that engage with this proactively are going to be better informed advisors for their clients to know what their clients are doing in the prediction markets and does that affect their behavioral risk. And it'll give them stronger client relationships by giving them more insight into macroeconomic trends that are out there. So, and Google Finance, for example, has just added Kalshi to the Google Finance interface, which essentially means anyone can, with a Google account, can access Google Finance and access some of this data. So as a financial advisor, you now have access to it. If you're not using it, it might be to the detriment of your clients.
So should we contemplate a world where over the next 5 years we see wealth management firms actually adopting and integrating the products onto their shelves?
I think that in the next 5 years, in the near term, I would expect kind of that distribution infrastructure to continue to expand rapidly, right? So you're going to find more brokerage integrations. You're going to certainly take a look at potential ETF structures. I know several asset managers that are already looking at constructing ETFs around prediction markets. And you're going to see deeper institutional product development around this, right? Um, Robinhood's already building their own prediction market exchange with Susquehanna. That kind of tells you where this is heading at this point, that we're going to have specific exchanges that are enabling this kind of capability. In the midterm, I would expect you're going to see more institutional adoption. You're going to see central banks and asset managers start to formally incorporate prediction market data, certainly in their research process initially. Because the Fed's 2026 paper kind of is the opening chapter of using that economic data in your research. In the long term, I think the prediction markets are going to become a standard part of the advisor's toolkit. both as a direct investment vehicle and as a real-time macro intelligence feed that they can get. Uh, the prediction markets at this point, there were a lot of people that were naysaying around the cryptocurrency market in the beginning, and look at where we are now. There's a lot of people naysaying around the prediction markets, and we're going to be, in a couple of years, we're going to be exactly where we are with the crypto market now. It's a recognized asset class, for better or for worse. you know, High net worth individuals certainly are diversifying outside of the traditional equity market, right? They're moving more into alternative investments. They're moving more into cryptocurrencies, and you're going to see them moving more into the prediction market space over time. Um, so as a financial advisor, it's in your best interest to understand these markets, become educated on these markets, and start a conversation with your clients about these markets.
In Canada, interest in event-based markets and investing is growing, but our ecosystem is at an earlier stage of commercial and policy development compared to the US. So can our regulators and policymakers ignore this for a while?
Um, my short answer to that is probably no. And I'm going to explain why though. So right now, Canadian investors do not have direct access to any of these markets, right? Now, Canadian investors that have a US address because they snowbird from time to time probably could access these markets through their US address. The reality of it though is the Ontario Security Commission banned Polymarket from Ontario in 2025, and they even levied a $200,000 penalty associated with that. Their legal basis really hinges upon a 2017 Canadian Security Administrator ruling that banned short-term binary contracts, which I think right now, what we've seen is the regulatory environment in Canada has been to reference that particular ruling and say that they're not going to allow access to these. But the issue is that that ban was really designed, in my belief, for all the right reasons, to stop retail investor fraud, right? And that was at a time where I think these markets were very nascent at that point, and there was this huge challenge with investor fraud. I think now is the time to really reevaluate the prediction markets as a financial category. You've got some Canadian legal experts that are now saying that the logic doesn't necessarily fit because it's more established asset class. The US has so far spent years in litigation before arriving at the clarity that we've seen in our adoption of the prediction markets. So Canada, I think, has a really interesting opportunity at this point. They can take this opportunity to look at what's happened in the United States, to look at what's happened in some of the other countries where Kalshi is available, for example, and to design a really thoughtful policy framework before the platforms begin to expand into its borders, right? So Canada's in this really interesting place where I think that they have an opportunity to really structure how they want these markets to be available for Canadian citizens without the explosive growth that we've seen in the US, right? The US has kind of figured it out as it's gone along. Canada now has this ability to really kind of Monday morning quarterback and say, okay, what worked over there? What didn't work over there? What's working in other parts of the world? What's not working in other parts of the world? And now let us take a leadership position to put together a thoughtful framework that offers a maybe even a better level of protection for Canadian investors, but can put together that framework really proactively at this point.
John, this is fascinating. Thank you for putting these developments into perspective for us. It's been an absolute pleasure having you with us. Thank you.
Thank you so much, Laura. I'm passionate about what I do, and I'm really appreciate you giving me the opportunity to talk about it.
Thank you for your time.
Thank you.